This week on Wall Street Wrap-Up, the markets closed with more highs than lows as technology and AI are the two letters investors are talking about. The FCC this week passed new rules for those pesky robocalls, especially right before the presidential election. And Moody's downgrades another regional bank to junk status. So are there more banks to fail? And the S&P 500 makes history today, crossing the 5,000 number, first time ever. So the popular song lyric, "Should I stay or should I go?" be the same for the investors? And tonight, we're going to be talking about the state of the economy, investing in 24, and more with the Chief Investment Officer of Raymond James, Larry Adam. You don't need me to tell you that the Super Bowl is this Sunday, but we will tell you some things about Sunday's game you may not know. We've got a lot to cover for the next 28 minutes, so join us because this is Wall Street Wrap-Up. Hi and welcome. I'm Andre Laborde. I hope you had a great week. So before we get to our show this evening, an update on last week's show with aviation expert Mike Boyd. Mike is CEO of Boyd Global International, talking about the problems of the Boeing 737 MAX jets. Well, this week, a report was released by the NTSB, the National Transportation Safety Board, from a January 5th mid-air exit door blowout of Alaska Airlines 737 that was due to missing bolts that were not in place when it left the factory before going to Alaska Airlines. FAA's Chief Mike Whitaker told Congress this week that his agency's effectiveness and its largely hands-off approach with Boeing is not working, and also said that Boeing are not delivering safe aircraft. And according to Whitaker, so we have to make changes. Well, with the presidential election just 9 months away, we'll all be getting those aggravating robocalls from politicians with celebrity endorsements. The FCC yesterday ruled that voice cloning technology of robocalls to be now illegal. Now, the ruling takes effect immediately for calls that mimic the voices of celebrities, political candidates, and even those family members. Well, the Congressional Budget Office, or the CBO, came out this week with some sobering information of the deficit, and not to be confused with the national debt. Now, this is how much we spend more than what we take in for this year of 2024. The government will now spend $1.6 trillion more than tax revenues take in. And in 10 years, by 2034, from now we'll grow to spending $2.6 trillion annually than what tax revenues take in. And the NASDAQ hit a 52-week high, and both the NASDAQ and the S&P ended positive for the week. Technology and industrials were the big leaders for the week. Energy, along with consumer discretionary, they were the laggards. And the Dow Jones today broke a 3-day winning streak, closing lower. And the S&P 500, they hit the 5,000 mark today, first time ever. And this week, Dow Jones closed up just ever so slightly. And the S&P 500, they closed up for the week 1.3%. And the NASDAQ, they closed up for the week 2.3%. America's three biggest banks collected 25% less in overdraft fees last year as regulators are now putting pressure to reduce those charges. Bank of America, JP Morgan Chase, and Wells Fargo all collected a combined $2.2 billion in overdraft fees, which was approximately $700 million less collected than in 2022. And this week, Moody's cuts the bank rating of New York Community Bank to junk status, which, for those not in the Northeast, you may not be familiar with the name, but the NYCB is also in the top 5% of regional banks with 420 branches all throughout the Northeast. And it's the 7th largest bank originator of residential mortgage loans. And it wasn't that long ago we had both Signature and Silicon Valley banks and First Republic banks all fail. Credit card delinquencies grew last year as more Americans are now living on credit cards and growing last year to 8.5%. And auto loan delinquencies has grown to 7.7%. All this while the S&P 500 hit a milestone this week, topping 5,000. First time ever. So can it last, or is the market now overbought? And is the economy in a slower pace than the original data suggesting? Well, are we headed for a recession this year? Tonight, we've got the Chief Investment Officer of Raymond James, Larry Adam, and he's here with us tonight. Hi, Larry. Welcome to Wall Street Wrap Up.
Thanks for having me, Andre.
Larry, I've watched you in the past, and I know you were saying before that for the second quarter, it's a possibility that we're in store for a recession. But that was a few weeks ago. Now, with all the data that's been coming out and such, do you still feel that way?
We do. We still think that we're going to see a mild recession here in the United States starting in the second quarter, but we think it'll be over by the third quarter. And I think that that's really important because we've been calling this the mildest recession we've ever seen here in the United States. And just to give you some flavor for that, we're looking for GDP to contract 0.3% during that time period. A historical average recession, you see growth decline about 2.5%. So it's going to be very mild. And for you, many of your viewers may not even know that we're in a recession.
Well, what about unemployment? I mean, would the unemployment picture have to start rising? Because I do know that technology companies like Salesforce and others to UPS last week was announcing how they were laying off massive amounts of people. Do you see the unemployment picture going higher?
We do. And in fact, if you look at our economist forecast, he thinks that during the middle of the year, we're going to lose probably about 1 million jobs during that time period. But again, compare that to the average recession where we lose about 3.5 million jobs. It's going to pale in comparison to that. The important part of that, though, is that once you start to see some of those job losses, that'll give the Fed the power, if you will, to then start to cut interest rates. And we think that'll begin as well around the middle of this year.
Well, do you think then the Federal Reserve, do you think they kept the interest rates too high for too long?
No, I actually think they've done a pretty good job. I think inflation was a problem. Remember, they have two mandates, right? They have, first of all, inflation, and then second is full employment. Inflation was a pretty big deal, right? Where inflation ultimately went up north of 9%. It's funny, in reality, inflation truly was transparent or transitory, like the Fed called it. It went up and now it's come back down. I think that they're pretty close to saying mission accomplished when it comes to inflation, and that their next step is going to be to look at the economy. And if the economy needs some support, which I think it will, I think they'll be ready to cut those rates.
Well, so we're already into 2024 now. So let's say they're starting to cut them toward the latter part of the year. And I don't know if you heard about this, but we have a presidential race coming up, okay? It was in the papers a few times, all right? So as they get closer, I know the Federal Reserve is very concerned on not wanting to be seen as political. Do you think that they would be so concerned that they would start to cut rates closer to November, that they don't want to be looked upon as trying to be helpful to one candidate over another?
That's a very interesting question because I get that from a lot of clients, right? And believe it or not, that if you look at election years, 85% of the time, the Fed has either cut or raised interest rates in an election year. To our scenario, 62% of the time, the Fed has actually cut interest rates during an election year. To me, that means that the Fed is not political. They're an independent agency, and they are going to do what is in the best interest of this economy. So I don't think that they're really worried about the politics. They're more worried about this economy.
Is there anything, because we're not that far off from the second quarter now, where we may be, as you're saying, having a mild recession. So between now and then, is there anything, do you think, either the Federal Reserve or anything that can be done to head off that possible mild recession?
So I think if you do look at what's happening with this economy, it does exhibit a lot of momentum, right? If you look, jobs are being created, retail spending has been coming in better than what people expected. So potentially, they could potentially guide us to what we call the soft landing. In fact, the reason I bring that up is because when we look at that amount of growth that we are going to lose, 0.3%, that's actually closer to us getting to a soft landing than it is to us being to an average recession. It's that close. So I don't think it would take much to help avoid, obviously, a recession. So if job growth remains healthy, if the government continues to spend, I think that's one of the fallacies out there. Everybody keeps focusing down in Washington about whether they're going to increase spending a little bit this year, keep it, flat, or actually cut spending. I think the reality is that there's been tens of billions of dollars already set aside, whether that's the Inflation Reduction Act, whether that's the CHIPS Act, the American Recovery Act, that was intended to be spent this year, in particular to bring back a lot of the manufacturing here to the U.S. And I think that will help support growth as well.
Recently, the IMF, the International Monetary Fund, they came out with their forecast for this year, and they said how the U.S. should be growing, and it's a forecast, so who knows? So their forecast for by throughout this year of 2024 should be up, I think, just over 2%, which is like third behind India and China. But we're ahead because I think they said Europe and Japan should be growing like less than 1%. Would that play into the scenario if, let's say, what we're saying about possibly mild recession for the second quarter, and let's say, it's hypothetical because we don't know, let's say we do have a growth rate of 2.1% or so, would that be going along with that type of thought of a possible recession?
So I'll focus more on our forecast, and we think despite the fact that we are going to have that mild recession during the second and third quarter, for all of 2024, we think GDP growth is a positive 1%. The significance of that is that if you look at all the other G7 countries, particularly in Europe and Japan, we're still going to have the fastest growth of all those other developed countries for this upcoming year. So, growth, I think you need to put it in perspective. And that's why when a lot of economists, a lot of strategists look back at the averages, you can't just look at the average because this is going to be, again, the mildest recession we've ever had in the United States.
Are there warning signs that we can look at to see? I mean, whether we're talking about bond yields. I mean, for the longest time, we talk about the inverted bond yields of a short-term 2-year paying more than, say, the long-term of a 10 or 30-year. Or are there other types of telltale signs that we can see to go, yep, that's what is coming?
So we do look at that indicator, and in fact, we're still within the realm of the inverted yield curve, as you talked about, predicting the recession. We're still in that window where it could still happen. But when it comes to economic activity, what we tend to do is we have a mosaic of what we call real-time economic indicators that really suggest to us when or if things are slowing down. So believe it or not, despite the fact that we've been in what they call the Taylor Swift economy, you are seeing less and less people going into hotels. Hotel occupancy right now is at a seasonal 3-year low. If you look at airfare traffic, it as well is starting to slow. If you look at restaurant activity, that's at like a 3-year low. One other thing we look at for high net worth individuals, probably one of the best ways to see how high net worth individuals are spending is look at the cost of a luxury watch. Luxury watches right now are at prices at 2-year lows. So that tells me that demand is starting to slow. And then one other one we like to look at is architectural billings, because that tends to be a harbinger of construction that's going to be done. Right now, that's at the lowest level since 2001. So I think it's important to look at those types of things to really predict or forecast whether or not you're going to go into a recession. And just to be clear, it doesn't take much to go into a recession. And what I mean by that is it's a simple question, but we ask people, we have a survey every quarter, and we ask our clients and people that work in a firm and on the internet, they answer our survey. And we ask them a simple question: are you going to spend more, the same, or less over the next 6 months than you did the previous 6 months? And most people say that they're either going to spend less or the same. If you don't have any growth in jobs, if you and I spend the same, that's a recession.
I saw one of your colleagues recently, Matt Orton, I think, who's with Raymond James, and he was also mentioning about that too when it comes to hotels and airlines, that they're seeing as a possible slowdown. And now that we're finishing one holiday season and we have not yet gotten into the summertime where more people take vacations, that might also start seeing a slower.
I do. I think one of the main reasons for that is that the consumer's starting to be more challenged, right? At one point, if you looked in aggregate, we had $2.1 trillion of excess savings in everyone's bank accounts. Well, from our lens, most of that's been whittled away and has evaporated. You have to keep in mind that people now have to pay back those student loans. If you look at credit card balances, they are stretched. And if you look at things like wage gains, while they're still positive, they're not as robust as they were, a year, 18 months ago. So when I start to factor in all of those things, I think the consumer is going to be a little bit more challenged going forward, and it'll start to challenge them, if you will, in going out for that extra vacation, that extra meal at a restaurant.
Let's say if wage, like you mentioned about wage gains, if wage gains are creeping up, but inflation is maybe going down, you'll be having more purchasing power. Do you see people, investors, maybe taking that extra money and putting it into the stock market or bonds or other investments?
Well, I think that with the excess savings being worked down, I think it depends on what level you are of your wages. I still think that the lower, the mid tier will continue to spend that on the things that they need day to day. If they can put an part portion of that into the equity market or into the bond market, I think they will. But primarily, I still think that we're at the cusp of people kind of normalizing their spending, that they're probably going to spend most of those increases in wages that they get.
Well, usually when we leave one year and go into the next, whatever the top sector was of that previous year is not normally the top sector for the following year. But what type of sectors would you advise your clients to be maybe looking to get into?
Well, when I look at valuations, and valuations are extended, we're probably at the most expensive valuations that we've seen over the last 20 years. I think you have to be in the sectors that have the best chance of having earnings growth this year. And the three sectors that I think will have the best earnings growth this year are technology, healthcare, and industrials. And what's in common with all three of those sectors is that they are all re-envisioning or reinventing how they're driving their earnings. So when it comes to technology, I do believe in the whole AI transition. And just to give you a quick fact there of the adoption rate that's taking place right now, is that currently about 50 million people use generative AI. By the year 2030, our analysts estimate that over 400 million people will be using generative AI. The significance of that is that by the year 2030, there will be more people using AI than you actually see them using their cell phones. So that's a very rapid adoption rate. So that actually gives you some visibility into the earnings power of technology. When it comes to healthcare, obviously it was one of the worst performers last year. We look for a rebound this year, but more important, what can drive their earnings, and right now they're slated to have the best earnings growth this year, is the fact that you are seeing new types of cures or ways to help people with their health, whether it's the obesity drugs, whether it's progress on drugs like cancer or Alzheimer's disease. And by the way, the average American now lives to be 79 years old. So there's plenty of healthcare needs that will help drive that sector. And then when it comes to industrials, as I mentioned earlier, I do believe in this industrial renaissance where our government is really incentivizing companies to bring back their manufacturing capabilities to the United States. I think that that trend will continue and help drive many of the earnings in that sector as well.
Humana came out with their earnings report, and it wasn't, I think they had higher Medicare costs than normal. Well, as you know, when it comes to Wall Street, everybody gets hit in that sector, which the healthcare sector, and besides Humana, you also had United Health and others went down on that. But that was for fourth quarter earnings, and we're now in the first quarter.
It's one of the least expensive sectors, particularly given what we're looking for from an earnings growth. If you look at me, or if you look at the consensus, that's forecasted to be the #1 sector this year from an earnings growth perspective. So I think that's a positive. The other positive is that I believe that healthcare as a sector in totality sits in an ideal situation. And what I mean by that is that if you look over the last 5 years, the healthcare sector has essentially had the second best earnings growth of the 11 sectors in the S&P 500, but it's the third least volatile sector. And in an environment or year where I think you're going to see a lot more volatility come to the surface in the equity market, I think you're going to see more conservative money start to come into that sector and help send it higher.
Energy last year was a down sector. It didn't do well. So now we're in 2024. So where energy was down in 2023, what are your thoughts about the energy sector?
So it's a great question because energy is our #1 contrarian call this year. Back to your point of looking at last year's biggest loser, can it rebound? And I think that when you look at the energy sector broadly, what you see is that it is the least expensive sector in the S&P 500. That particular sector generates the most free cash flow of all the sectors. And when you have a lot of cash flow, what do you do with it? You either invest in the future, increase your dividend, or increase your buybacks. The last time I checked, all three of those things are good for investors. And then from a contrarian perspective, if you look at the numbers, last year, energy was the second most unloved sector of the 11 sectors, meaning that investors in general were pulling out all of their money. And I think that that speaks volumes, because it won't take much for them to obviously reverse themselves going forward. And I think, given some of the geopolitical tensions out there, I think the energy sector is one way to hedge some of those risks you were talking about, particularly over in the Middle East.
What are your thoughts on dividend stocks? And especially with what we talked about earlier with the Federal Reserve lowering rates, those usually help dividend paying. So I'm thinking about like real estate, REITs, or other types of dividend stocks.
Yeah, when we actually talk about our dividend stocks, we tend to focus on companies that have the ability to continue to increase those dividends over time, right? Not just looking at the sheer magnitude, because that's not necessarily, in our opinion, the best way to look at it. We want to look at companies that have long-term growth and can grow those dividends. I see a lot of those in the technology space, in the healthcare space, in the industrial space, where year after year, they're actually increasing their dividends because of the power of the earnings that they have, that they can afford to increase them.
This year, I think there's something about $500 million or 500. I think 500 billion is coming due in commercial real estate loans. And over the next few years, like in 2028, they'll be even into the trillions. Do you think that banks, and with commercial real estate, are banks going to be able to refinance these type of loans? Do you think that we see a problem coming up by the end of this year and maybe in the couple of years with regional banks?
So it's a good question, because, again, I look at the sector broadly, and it could be a potential problem. But I will say that I recently spoke at a CEO roundtable that included regional and community banks. And I think they brought up a very important point. And that is that when we had the great financial crisis, where, we had the housing bubble burst, you had everybody having mortgages, but nobody knew who owned the mortgages, because they were being sold in different products and to different players, right? So you never knew how to help the individual person. When it comes to these regional banks and these community banks and commercial real estate, they tend to know on a personal basis who actually owns that particular piece of commercial real estate. So they've already been in contact with them. They're already trying to work it out, so to make sure that they don't lose as much money as they did before. So my gut tells me that I don't think it's going to be as big of a problem that we had in the great financial crisis, because banks will work with the actual borrowers to try and help them as much as they can to make sure that you don't have the ultimate debacles where things are defaulting massively throughout the entire economy.
Larry, you've talked to a lot of people, and most at Raymond James. I mean, your clientele is more retail as compared to some that would be more institutional. What's the best investment advice were you ever given?
To stay invested longer term, and to stick to your asset allocation, and don't do the panic-driven mistakes. I think you've probably shown it on the show multiple times that people, when you get volatility, they tend to sell at the market lows, and they don't really reap the benefits of the rebound. So I think you stick to the strategy. In fact, we have research that looks at this. In fact, we've gone back to 2008 to most recently 2023, and we do 3 different strategies. One we call momentum, which is you get into the best asset class, whatever it was that year, for the next year. We do a contrarian one, where whatever the worst performing asset class was, we get into that one. And then we have a simple blended portfolio, which is 60% equity, 40% bonds. The results are that if you get into that momentum, believe it or not, on average over that 18-year period, you're actually slightly down. You get a little bit of a boost if you do the contrarian, but by far and away, your best performance is to be in that blended portfolio year after year, rebalancing it back to the target.
Larry, I had a lot of fun. I hope you come back.
I can't wait.
Thank you, Larry. Hey, if you've got a question, maybe a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us at andre@benacapital.com. So now for a wrap-up on Wall Street. Well, this Sunday is Super Bowl 58. I know that's not news. Well, neither is when I tell you that there's going to be a lot of betting going on Sunday's game. And just 6 years ago, sports betting was illegal outside of Nevada, and the NFL actually fought against legalization. But now, Las Vegas is hosting its first Super Bowl and the home of gambling on the big game. Now, according to the American Gaming Association, over 67.5 million Americans will be betting on some part or all of the game, and over $23 billion is expected to be wagered, which is a 35% increase from last year. Now, some of the crazy bets this Sunday are going to include how many field goals will be kicked, plus how many of those field goals will be hitting the crossbars. Or will the coin toss land on heads or tails at the beginning of the game? And what color will the Gatorade be that will be dumped on the winning coach of either the 49ers or the Chiefs coach at the end of the game? And of course, the biggest bets are not on the score, but how many times will the cameras be showing Taylor Swift in the Kansas City Chiefs box? Because of the 165 or so television cameras on Sunday's game, I think one will be on the field and the other 164 are going to be on Taylor Swift. Now, a 30-second commercial for Sunday will be $7 million compared to a 30-second commercial spot in 1967 for Super Bowl I, a 185,000% increase. So, join us next week when we talk with portfolio manager and partner at Villery & Company's Sandy Villery. We've got a lot to discuss with Sandy, from how to invest in AI to stocks to buy or bail in 2024. And that's a wrap-up on Wall Street Wrap-Up. Our thanks to Larry Adam for being with us tonight, but always, we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and also remember, money never sleeps. Good night.